we delivered a very strong quarter, reporting attributable profits of 2.1 billion, which is equivalent to a return on tangible equity of 12.3%. But we are seeing these profits based on strong top-line growth, which is, I think, going to set us apart from most of our competitors, because revenues were up 8% and pre-provision profit up 13%. Also, obviously, provisions were reduced, and that obviously flew all the way through the bottom line. But I think the key element of our results is growth. And like we've said in the past, Santander clearly is growing above and beyond our competitors in the markets where we operate.
You've obviously brought down the level of provisioning as well. Could you talk a little bit about what risks you see at the moment in terms of your exposure, particularly maybe in Latin America, where we're seeing economies struggling a little more compared to perhaps the UK and the United States?
Well, we arrived at the crisis with much better level of provision, so we were very well prepared for these. And obviously they remain at very high levels, and we've been cautious in those segments, particularly SMEs, where we believe it might take a bit longer to recover. Credit quality in individuals is very, very good, and it's worth highlighting that 92% of the moratoria in all the countries where we operate have expired, and only 5% of these are accounted for in stage 3, which is equivalent to non-performing loans. So generally, we are seeing very, very good evolution of credit quality.
It's very good to see you. So look, you've got great evolution of credit quality. And by the way, I'll tell the viewers that Spain as a country had over 7% ill-performing loans back in 2012. Well, this time round, much lower figures. Yours only 3.2%, way better than the 5% handle you had in 2012. So this crisis is being handled better than the banks than last time round as well. With that in mind, sir, is central bank policy appropriate, given that you've just talked to us, and I'll quote you, profit growth of 13%, revenue growth of 8%, and incredibly low bad loans?
Well, clearly, I think that the monetary policy is definitely appropriate. I think inflation is set to rise this year, probably due to a series of transitionary circumstances, largely linked to the end of the pandemic. But there are good reasons to believe that inflation is going to drop next year, although obviously, this risk should be monitored. And I think the revision of the inflation target is moderate and reasonable, given the changes in the economic environment. Remember that the last time the ECB changed its monetary strategy was back in 2003. So it was time to really update its strategy.
But in terms of the figures we're seeing from the corporate world, literally, sir, the last few days, we've barely seen a company on either side of the Atlantic who has done anything other than massively outperform expectations as well. Is the corporate world and the banking world then, specifically in your case, sir, a bad metaphor for what is going on in the broader economy? Because it seems we have parallel worlds. We have monetary support at crisis levels, but we have corporate action, which is going incredibly well.
Well, I think the world economy is already on the road to recovery. We've seen countries like China where the economy is at pre-crisis levels. The U.S. reached its pre-crisis levels in spring, and probably Europe, we are going to see that in 2022. So generally, things have gone better than expected, and that thanks to the rapid and even development of vaccination, the success of highly coordinated economic policies. Also, Latin America that you referred to is clearly benefiting from the rise of raw materials. So I think we are seeing a wide recovery. And again, I think the risk here is that this spike in inflation that we are seeing is not temporary, but everything seems to indicate that it's temporary, and therefore monetary policy seems to be appropriate at this time.